Our guest says the heavyweights in the Canadian dividend space have been doing well. It doesn't apply to all dividend-paying stocks. And he says more money is set to flow into these dividend companies, partly because GICs are rolling over and investors don't like the low rates on offer. Let's get more from Ian de Verteuil, Head of Portfolio Strategy at CIBC Capital Markets. It's great to see you.
Good to see you, Andy.
Maybe we can pop up a comparative chart here showing the TSX banks and the TSX composite, because of course the banks famous for their dividends and they have been outperforming.
Yeah, absolutely. And we've seen it, banks, depends on your time horizon, but certainly over the course of the past year, we've seen banks, insurers and pipelines actually outperform the TSX. Which, as you well know, is a market that's been driven by a huge rally in gold stocks and IT stocks doing extremely well. So I'm going to take three of the sectors beating the market quite handily and utilities performing in line with the market. I'm going to take that as a big win. There are only two of the yield sectors which have lagged so far over the last 12 months, and that has been the REIT space and certainly the telecom sector. What the communication sector has done quite poorly. But we still think there's a fair amount of rotation trade still ahead of us.
And the GICs are a big... remember the old GIC refugees?
That's right, yeah.
It seems that phenomenon is going on again.
Yeah. Well, what really happened, though, and everything needs a bit of context, as you well know, what happened is as rates spiked in 23-24, what we had was suddenly you could get risk-free, one-year money at your bank for 1 year locked in, yielding over 5%.
Nice.
And I think in that type of environment, we could haggle a little bit of inflation spiking there, but there was very much a sense among all of us, particularly you and I with the gray hairs, that 5% risk-free money for a year was sort of a slam dunk. And we saw this acceleration in GIC deposits on bank balance sheets. So when you look at it, we probably still have, we can see, there's empirical evidence of this, a couple $100 billion worth of excess GICs over and above the norm that's existed. And these are all, as you mentioned on your intro, just repricing lower bit by bit. So there were 5, they're now below 3 on 1 and 5 year GICs. And if the Bank of Canada continues to do what we expect, which is cut rates further, there'll be more and more pressure to actually search out more yield in Canada.
And you say the basic yield on the TSX itself, never mind the dividend stocks, beats many money market
beats many
products.
things. So on the TSX, you can buy an index here which is broadly diversified. Now, I know someone's going to say, oh, well, Ian, there's lots of resource stocks and financials. That's true. Banks are about 20% of the index. But really, it's a relatively broadly diversified index that you can clip a 3% dividend yield on. And let's keep in mind, in basic investment accounts, so not tax-preferred accounts like RSPs or RIFs or TFSAs, there's a significant tax advantage on dividends over stocks. So a 3% dividend yield is almost like a 5% equivalent if it was an interest product, an interest income product for most taxpayers across the country, most of your viewers. So I do think we're into that stage. So we've got early performance out of the banks and insurers and the pipes from this. But that money really has been slower to move than I would have thought. So I still think there's more to come. We can talk to why that's been slower.
Why has it been slower then? People are just wary of the stock market itself amid tariff fears, maybe?
So a couple of things. You and I grew up with the term GIC refugees, which is that these individuals were locked into GICs at higher rates early on in our career and were terrified to move into other things as rates continue to come down. So I do think the bulk of these investors are quite conservative investors. They're individuals like you and I that just swung a bunch of money in when rates were that high. But I think a lot of investors generally are relatively risk averse. So a 5% risk-free rate was particularly attractive. So I think the money just takes longer to move than you think. That's one piece. The second piece is there is duration to this book. So in other words, if you had a 3-year GIC yielding 5 and it still has 6 months left on it, you're not gonna very often if you try to redeem on that, they will force you to give back some of it. So there's just a term to the book. It just takes time for some of the maturities to occur.
Give us that point again, Ian, sorry.
Sure. So your GICs might be 1 year, 3 year, 5 year, whatever it is. If 3 years in on a 5 year GIC, the market starts to look really interesting, you turn and say, well, I want to go buy that, but you actually are locked in for the 5 years. To get that premium yield, the bank required you to commit to a duration on it. So there is a term to the book. So it takes time for this to actually work through. Right. So that's the second factor. And the last thing is, let's not forget, we went into that April famous Liberation Day where we had this tremendous volatility. So if you had GICs maturing around then and you'd go, my word, I don't know what's actually going on here, then I think a lot of people would say, you know what, let's just roll it another year in the GIC. I know the rate's not that good, but let's just roll it. Alternatively, we may have seen some coming in the money market as well, and we did see money market experience some inflows. So I think those three things, but I think at the end of the day, we can see what's gone on in the bank balance sheets. We can see that the GIC money is still elevated, and as rates continue to come down, we believe that money will continue to flow into these sectors. So we've got good returns on some of them. We would expect it to broaden out to include the REITs and the telecoms, I think, as we move forward, because many of the telecoms, as you well know, have not done well.
No, our own parent company, BCE, cut the dividend. And
exactly, but on a number of these companies, you can get 6-7% dividend yields currently, which on a tax-preferred basis is almost equivalent to an 8-9% interest income yield. You are taking, let's make sure we're clear to all your viewers, you are taking additional yield because there is price volatility.
Yes.
But at the end of the day, if you look at most of these stocks over time, over any longer term time period, 1 year, 2 years, it has been, over that period of time, it has been, they've actually gone up. Not only have you clipped your coupon, but you've actually got the appreciation in the stock as well.
I know it's perilous to assume history will repeat itself. But sometimes I wonder, should investors just put all their money into Canadian blue chip dividend paying stocks? Because that's a strategy that has worked over the years.
Yeah, my brother-in-law, retired really early, got all his bank stock, just kept doing it when you could do DRIP programs, when the banks would offer dividend reinvestment programs at par, would do those types of things. And it's quite amazing what it is. I mean, the number of times I speak to over my career, I spoke to individual investors, and they would go, do you think I should buy the CIBC over the TD, over the BMO, because I think this one's a little bit cheaper? And the first question I would always ask is, what's your average cost base on your bank stocks? And invariably, there'd be single-digit numbers. So stocks would be trading at $60 to $70, and you'd say, so your cost base is $5. So if you sell it, the capital gain will be this much to try to correct those, just to collect that, whatever. So I think there is a lot to be said from owning that. But I do believe a broadly diversified portfolios with a large slug of these high-yielding companies, but not just high yield, but high yield with business models that have shown the test of time, that have gone through floods, famines, pandemics, economic slowdown, whatever it is, and owning these things over the long term has worked. And I still think that makes a lot of sense. For sure, using some kind of diversification into the U.S. to try to buy some tech stocks, some healthcare stocks, some of the great branded goods companies, that makes sense from an overall portfolio point of view. But I think a good solid grounding in Canadian equities, particularly in some of these high quality entities, banks, insurers. I think the railroads have always had a remarkable long-term performance. The grocers have had remarkable long-term performance. I think these things are outstanding investments over the long term.
We're tight for time, but I'm always intrigued to hear what strategists like you think on this one. The dividends versus stock buybacks. Which do you think is better for investors? I know it's a very broad question.
I would say, I think from a financial point of view, buybacks are actually more lucrative for our investors, for your viewers. And the reason I would say that is dividends are taxed at 40% for high-income Canadians. Capital gains are taxed at 26%. So if the stock actually goes up, you'd expect theory would tell you, you'd be compensated. You can actually sell the stock, book a 26% gain. You're in control of when you trigger that gain.
Yeah.
But on a dividend, it's every year you get the tax statement. So I think that's there. Having said that, I do think a level of dividend. Dividends are like marriage, and buybacks are like dating. Like I do think the dividend gives you stability. It is a commitment by the board, commitment by management of some sense of visibility on what we're going to deliver to you. The buybacks are episodic, I think. Some companies have been able view their dividend. They have a base dividend, and then when there's excess capital in a particular year, they have a good year, but they don't think they're going to have that greater year for the next couple of years. They would use the excess capital to buy back stock. So I think it's much more core dividend plus episodic buybacks over time. And I think that works and you look at the companies that have been, I think the railroads, I think between CN and CP, they've bought back 10% of every buyback done in the TSX over the past 15 years. They're in a stable business. They're in a business with competitive moats, but you can have freight recessions, so they have a level of dividend that they're comfortable with, and they will buy back stock periodically when they've got the excess.